Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday, the 16th of May, 2025, and joining Derek to pose some questions on the financial market themes for the week ahead is Jack Greenslade from Corporate FX Sales, MUFG. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi, Derek. How are you?
Not too bad, Jack. And you?
I'm very well. The sun is shining. I've just come back from a bit of annual leave, so I'm feeling nice and relaxed.
Well, I've had a busy week, so I'm looking forward to the sun at the weekend.
Yeah, indeed. Speaking of the weekend, obviously last weekend we had some of these headlines out of China and the US on the trade negotiations, and we had some large FX moves on the back of that. You know, we saw the dollar stronger, we saw safe havens weaker. These currency moves have mostly unwound now. Why might that be the case?
Yeah, so the initial dollar bounce was after the press conference on Monday morning in Geneva, and I think there's probably a couple of different factors, but I think one, doubts I think crept in pretty quickly in terms of the idea that, damage is already being done. And while this is a retracement and a very different status for the next 3 months in terms of US-China, the uncertainty is still there. The other reciprocal tariffs come in July, and there's lots of trade negotiations going on. So there's still a high level of uncertainty, but of course not as bad as it was. So I think that played a role. I think also if you take the optimistic element of it being good news, it's also very good news for the rest of the world. Mm-hmm. Obviously, with the two largest economies effectively in a trade embargo, the removal of that is good news everywhere. And I think that helped to lift sentiment for non-dollar currencies in reaction to that as well. And I think as the week has unfolded, then we've had data, in particular towards the end of the week, where we had the CPI, which was weaker than expected. Then we've had retail sales and PPI, which were on the weaker side. So the yield bounce on Monday in response to the de-escalation has also retraced, and two-year yields are pretty much back where they were on Monday. So I think that's a factor as well. So, yeah, like equities have held on to the gains. So the risk sentiment is still pretty positive. So maybe the best choice of those options in terms of explaining it might be the risk. Risk is back, but it's also back globally, and that's positive, and it's positive for non-dollar currencies.
Mm. I understand, obviously, tonight that we have some tick data out which you track. Given what you've spoken about with softer US data this week, do you expect to see that US exceptionalism begins to wane, perhaps?
Yeah, like I think this theme is going to run. I would guess potentially for the entire presidency. It depends, but certainly, we've had a very long run of that kind of US exceptionalism theme, and some of it very valid, in particular in terms of tech, obviously, and the flows into tech and the outperformance of the Magnificent Seven. But, given the policy developments, given volatility, given changing risk appetite and emerging advances in China in relation to tech, I do think there's definitely justification for at least expecting some reweightings of global ownership of assets. And, for what I've just been saying, there has been, a big shift into US markets, and just small shifts back the other way would certainly have big implications. So I think the tick data going forward from here, it is going to get a bit more attention given that theme in the market and the theme about foreign official entities in particular. Dollar reserve currency status, is that being questioned? What I would say on that is, obviously can't predict tonight in any way, but the data has shown a consistent theme for some time, essentially since reserves kind of didn't top out, but the pace of reserve accumulation was rapid up until 2014. And you had central banks buying dollars because of dollar depreciation. And of course, since 2014, we've had a dollar bull run in place. And that means the pace of reserves has slowed quite notably. And therefore, buying of US Treasuries by foreign entities has been much less clear since then. And indeed, in recent years, there's been pretty heavy selling by foreign official entities of US Treasury securities. There's been some replacement of purchases of US agency debt, but not offsetting the US Treasury selling. The big point, though, is that, and when I look at foreign central bank selling of US Treasuries, we're talking 29 billion in total in 2024. They were net buyers in 2023. They were net sellers of 173 billion in 2022. But the purchases of US Treasury securities by private investors abroad has been huge. So $500 billion foreign investor, private investor purchases in 2024, 545 billion in 2023. And there's been very strong private investor buying of US Treasuries since post-COVID. So the real story is, not necessarily focusing on foreign central banks who've been sellers for some time. It's, do private investors abroad start to turn away from the US Treasury market? Then you'd really see the impact in terms of yields and greater volatility and greater financial market disruption. But certainly there's no evidence of that so far.
And potentially, I guess, a weaker dollar on the back of that as well.
Yes, because I think it would just reinforce that kind of loss of confidence in not just the US dollar, but the US Treasury market. And that could have big implications. So in that context, like the tax cutting bill is on its way through Congress as we speak. A bipartisan estimate is a $3.8 trillion addition to US debt over a 10-year period. This can't carry on. I know many people have said it for a number of years that, US deficits and US debt is becoming unsustainable. But, running 6-7% of GDP deficits every year, and this will continue if this bill goes through, it's going to have an impact at some point. And the risks of that type of scenario of dollar weakness and US yields moving higher, like what we had briefly after the announcement of the reciprocal tariffs, I think we're going to get more and more examples of that.
Well, we're seeing that kind of expressed in the options market more and more as well. I was looking today at euro dollar, $25 delta risk reversal. And it's now not only positive, but it's the most positive since COVID. So the options market is the most bearish on the dollar in a lot of tenors since the COVID extreme. So it's it's an interesting situation.
Yeah, and I think if there is a shift in reserves in terms of dollar reserves, we're at about they're 58%. They're actually at their lowest level since 1995. So dollar reserves are coming down, but it's kind of smaller other currencies that benefit most. I think we're about set up for the euro to take on more of that gradual decline in dollar reserves. We've got rid of negative rates, which I think is really important for reserve managers. They're not going to invest into negative yielding fixed income. So I think the backdrop is changing and becoming more supportive for the build-up of euro reserves. Yeah.
Well, we talk about G10, but obviously, we've seen some very extreme moves as well in Asia EM. Specifically, you can look at the 10% move weaker in dollar Taiwan. What do you think's behind these rapid moves in Asia EM specifically?
Yeah, this is interesting and kind of ties into maybe what we were just speaking about in terms of, not necessarily questions about reserve currency status, but in a way linked to that in part is this perception that the Trump administration wants a weaker dollar. And it's quite a strong perception. And I think it has a lot of logic. Because if the Trump administration are obsessed with closing a record trade deficit of $1.2 trillion, a weaker dollar nearly has to be part of that. And in that context, if investors abroad start to believe that, then what in the past has tended to be a normal kind of global flow is, and again, this goes back to pre-2014 when the dollar was weaker and we didn't have that surge in the dollar in 2014, 2015. What normally would happen is that central banks in Asia would buy dollars, sell their own currencies. They can do that as much as they want. And then they would purchase US Treasury securities. But now with Trump in the White House, it's clear that they're not happy with that type of infrastructure or structure, if you like, or framework. So it could be that central banks are going to start kind of pulling back and not being as active in order to keep the Trump administration happier. And then that starts to change investors' perceptions about the downside risks to the dollar versus their own currencies. So take Taiwan, for example. Taiwan's life insurance sector is very large, and in GDP terms is much larger than standard or average. I think it's about between 90% and 100% of Taiwanese GDP. Whereas, for example, in Japan, it's about 65%. And in other countries, it's lower. So it's relatively high. So we've just come from a sustained period of dollar strength. And we've also just come from a period of it being very expensive to hedge dollar exposure because the Fed hiked rates aggressively. Now we're at potentially a turning point. The Fed have been cutting rates, and there's these big question marks about the outlook for the US dollar. So suddenly investors and hedgers are rethinking. And they're saying, are the hedge ratios that we have in place on our dollar-denominated assets, are they high enough? Even though it's expensive, we may have to wear some of that to cover the exposure of the downside risk. And certainly if the Fed continue to cut rates like we do, we think they'll start cutting again later in the year, and hedging costs come down more, then your incentive to hedge is increasing all the time. Especially when you get a dollar Taiwan move like 9-10% to the downside. Dollar Korea again this week had a big move down.
Yeah.
That starts to play on investors' minds, and it starts to alter behavior.
And you mentioned just a second ago around central bank control of currency and things like that. So do you think that we're in a new phase where some of these Asian jurisdictions provide a looser control over currency and allow their currency to strengthen against the dollar a little bit more as part of maybe trade negotiations?
Yeah, I would certainly imagine, based on Stephen Mirren's, the head of the Economic Council of Advisors in the administration, based on his views about reserve currency status, meaning you don't get the required adjustment in the dollar to close trade deficits. If that's the belief in the administration, and I think it is, they will definitely be telling in these trade negotiations that, you've got to stop. I wouldn't say completely, but it needs to be more contained in order to allow for an orderly adjustment weaker of the dollar. I would guess that's, we'll probably never hear that explicitly, but it does make sense given the ultimate goal of the administration that that's what they'll be saying in when they meet in particular countries in Asia.
Great. And finally, just any trade recommendations you may have this week.
We have held on to our long euro versus the New Zealand dollar. I guess what we need there is some increased volatility, some risk aversion. You would imagine Kiwi would underperform. If risk really comes back, yeah, we'll see some losses on that. It's maybe slightly out of the money at the moment because of the pickup in risk sentiment this week, but it's held in pretty well. And we've just established a short dollar yen. I just think we've had a bounce from the lows in dollar yen, but we're already petering out. We've seen a fairly notable correction this week, even with equity markets where they are. So I do think the underlying momentum is still quite negative for dollar yen. And my sense is that this rally, there's plenty on the sidelines waiting to sell. And the price action this week tells us that it's a good risk reward trade going forward. Like next week, there's not a whole lot from the US. So data-wise, yields in the US, nothing specific next week. But of course, the following week, we go into month-end, start of the new month, and you're starting to get into the labour market data, culminating in the non-farm payrolls, which we think is not going to be as strong as last month or beginning of this month for April. So, yeah, I think it fits with the idea that we start to see better evidence of slowdown in the US, and dollar yen should go down on that.
Okay. Thank you so much for speaking to me.
Thanks, Jack.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe, and contact your MUFG sales rep for more information. Join us again next week for more expert insights from our global markets research team.